Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Friday, January 14th, 5:21 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video, the Big Show edition, because you know if it's Friday and it's me, it's the Big Show where we'll take a look back at the prior week. Actually, going to take a look back at the prior 2 weeks. I haven't done a video in a long time now, so let's got some catching up to do here. And then, of course, we'll look ahead to what you need to know for next week. The 21 over 21 list, we'll look at the tatters that's in. I know Hunter's been keeping you up to date on that. But I want to take a look at what it looked like at the beginning of the year 2 weeks ago and what those stocks look like now. And it should be no surprise to anyone that we are as defensive as we are, especially if you look over here at the trend gauge. Leadership we downgraded last Friday. That was actually twice within a week we downgraded from bullish to neutral and then to down. Short term has been in a bearish downtrend since last Friday also. Medium, using the 50-day moving average, the major indexes were hanging on by a thread to neutral there, pointing toward bearish. Long term, we're still in a bullish uptrend going all the way back to July of 2020. But the market is probably in the most precarious state it's been this entire time that we started getting back above the 200-day moving average after the COVID sell-off. So we're going to dive into all that on the charts here in a little bit. So what happened today? Tech's bounced, Dow lags. Dow's not always the safest place to be. Generally speaking, from a relative strength standpoint, it might be, but wasn't today. And we've upgraded the G5 to the G6 now. We added the mid-cap growth index to our calculation. G6 was down 0.13% today. S&P 500 recovered nicely. We gapped down at the open. Really not a nice gap down at all. Retail sales were horrific. Consumer sentiment was bad. We gapped down. We popped. We made two legs down to new lows. But a decent afternoon rally got us back to even on the S&P 500 and on the NASDAQ, up 0.6%. Dow, as I mentioned, down 0.6%. Mid-caps down a third. Russell really bifurcated. The growth portion is just devastated. Value portion, thanks to financials and oils, just holding up very well. It was slightly positive on the day. So let's get to the tail of the tape and the charts. But first, let's get to the team here at Revere. You're interested in an approach, a trend-following approach. It stays on the good side of the market when the market's in good shape, gets out of the way when the market's bad. Give us a shout if you're interested in this approach. You can email any of us, Don, Tim, Hunter, Muriel, Alex, or Don at revereasset.com, or phone 855-REAL-WEALTH. That's 855-732-5932. So let me bring up the tail of the tape here. So index consolidation, very clearly. Leaders correction, though. They've just been hammered. I've talked several times how we had a second growth, stealth growth bear market in the G5 starting in November over the last couple of months, and that really new lows made on that this week, in fact. But let's start off with the S&P 500, and this is why the S&P 500 is the granddaddy of the indexes. Okay, you could argue that the Dow Jones is the granddaddy. I get it, but the S&P is the most diverse, and all rotation takes place within the S&P 500. So when money comes out of tech, goes into energy, that happens. Just adjusts the weightings within the S&P 500. Fund managers are closet indexers. They have to pay attention to what's going on with these weightings, so they'll buy the things that are being bought. As the S&P 500 rotates, they'll sell the things that are being sold. So we keep an eye on that. This is the ballast of our portfolio. And until it severely breaks down under the 200-day moving average, the market doesn't get into bad shape. Now, that doesn't get into bad shape if you're an index investor. If you're a growth investor, you've gotten hit in the head with a 2x4 twice over the last 2 years after enjoying a stellar 2020. So So let's take a look at the S&P 500 here. So coming into the year, we were, at highs. Decent day. The first day of the year made higher highs the second day, but reversed, and growth stocks really started getting hit under the surface on the fourth, we noticed, and then we got hit hard on the fifth, and this is really when the change in character started on the indexes in the fifth. We had 3 additional hard days down. You don't always go down every day, so a very logical place to bounce was on the 11th near the 100-day moving average, very similar to what's happened twice going back to the end of November. The 100-day moving average also very key. We don't pay as much attention to it as we do the 50 until we break the 50 because, well, obviously if you're above the 50, you're above the 100, so it's not doesn't make sense to really discuss much about it. But when you break the 50, the 100 then becomes a target, and you want to pay attention to what's happening around that 100-day moving average. So we got our big bounce on the 10th. That was Monday, close to the top of the range, followed through 2 days. Correction's over, right? Nope. Big whoosh down day, very ugly day on Thursday, broke back below the 21 and the 50 on the S&P, followed through selling to the downside this morning, but then again we bounced into the close. So overall, here's your green line here. That's the 21-day moving average on the S&P. It's pointed down. That's bearish. The S&P 500 50-day moving average, the red line here, that's flattening out. That's also not good. These are the 2 areas we're paying strict attention to. We're on track we stay down in this area for the 21 to close back below the 50 and the 50 to roll over. Then we want to see if that continues. What happens when we get down here near the 100-day moving average? That's the purple line, and then the 200-day moving average is another 5.5% down to there. We haven't touched the 200, as I mentioned, over a year and a half. We touch it very clearly from time to time. We may be due to touch it this time. We don't predict. We know that growth stocks have been decimated, but all the money has flowed into some safety sectors. And if money right now is still just being rotated around big cap stocks, if money starts to exit the market and maybe flow into bonds or commodities, then the market itself will roll over and will break the 200-day moving average and possibly be in for a more severe correction. But until that happens, we're going to maintain some exposure. In this case, our exposure is about 25% of the risk of the market, as we trimmed a little bit of SSO today and increased our hedge against our SSO position. So about 25% exposure is what we have right now. Let's go to the NASDAQ 100. This is looking worse than the S&P 500, but what we can say, well, I do want to mention this though. Let's go back to the S&P 500. The best thing that you can say here is that we're still making higher lows. Okay, so that's why the lows of Monday's shakeout are critical. If we make a lower low there, then we're starting to be in a situation where we're now making lower highs and lower lows, and that is the definition of a downtrend as opposed to an uptrend. But for now, we're still making higher lows. Let's go to the NASDAQ 100, the QQQ. So bottom of the range is again the best thing I can say for that, but we did make lower lows on the NASDAQ 100. This index typically leads stocks higher and lower, and 2 things that I really don't like are the attempted rally on Wednesday and Thursday ran right into the declining 21-day and failed. That's the green line here, and we also failed to break below the 50. The 21 moving average broke below the red line. That's the 50 moving average. So now our moving averages are out of whack on the NASDAQ 100, and that's not a good thing. Look at the lack of relative strength over the last 6 weeks in the NASDAQ 100. That's not a benefit for the market. Quite simply, money coming out of tech and going into safer areas. Let's go to the Dow Jones Industrial Average. We'll look at the DIA. Just made new highs less than a week ago. 4 harsh days of a pullback. Bounced along with the other indexes, 2 days up, higher high negative reversal, undercut the 50, came within a point of the lows from Monday, and then bounced and closed back above the 50. So look at the relative strength here. It's positive, which is again is typical because this is your defensive index. And keep an eye on what happens here below the 21, and the 21 is rolling over. 50-day moving average is flat. Monitor the Dow versus the NASDAQ 100 for risk on and risk off. Let's go to mid caps. Not too bad, bounced off the 200-day moving average, but really nothing to write home about. We're below the 21, we're below the 50, both have rolled over. Not good. IWM. This looks terrible, but it could look a lot worse. This is your small cap index overall under the 200-day moving average. It's been lagging for a while, but look at this version of it, IWN. This is the value portion of that index. That's actually setting up with a cup and handle. It's got a lot of financials and a lot of oils in it, but now look at IWO, the growth portion of it, and that looks like lower lows going all the way back to the beginning of last year. Not what you want to look for. And again, here's that big stealth bear, the second one that started in November. And let's go through real quickly now the 6 components of the G6, and you'll see very quickly what I'm talking about, why we actually own no stocks in-house right now. Got rid of the last few of them early last week, right after the new year. 75% of stocks follow the trend of the overall market. Certainly not a spot for any growth investor right now. There are a few candidates. We'll talk about a couple of them in a little bit. But here's IWO. Let's talk about MDYG. This is the new one that we just added. This is the growth component of the mid caps. Bottom of the range, new lows versus Monday's lows, but it did bounce and come off the low. But again, note the lack of relative strength going back the last 10 weeks or so. Just in keeping with the rest of the G6 components that we monitor. Here's PDP, that's one of them. Protracted downtrend, QQQJ. Terrible. FFTY, the IBD 50. Terrible. And of course, the horrific ARK-K, Cathie Wood Index, lows going back to all the way back to July of 2020. So what goes up must come down very often, and this is why Bill O'Neill's rule. I remember the first couple times I read his book, and he gave the statistics: 72% of leading stocks, once they top, they correct. Leading stocks, once they top, they correct on average 72% from their all-time highs. I remember reading that over and over and over again and just frankly not believing it. But when you see it in real time at what happens to some of these growth leaders, you learn very quickly that you better subscribe to the loss-cutting principles that he talks about, or you're just going to get carried out on a stretcher. Think about that, 72% correction on average, and we see it over and over and over again with growth stocks. That's why we're so meticulous about our loss cutting. So let's get to the 21 over 21 list now. And the first thing I want to do is talk about the 8 that got cut the first week as we started the correction. And we'll see where they are now. Start with Cube. Doesn't belong anywhere near a leaders list, as this rolled over and has continued lower, coming up on the 200-day moving average. Costco, old reliable Costco. Wouldn't think it, but it's rolled over. 21's rolled over. It's on the 100-day moving average here. American Tower, one of the safer stocks you would think. When there's nowhere to hide, there's nowhere to hide. And when moving averages break, get out of the way. You don't know how low things are going to go. This one doesn't belong on any leaders list right now. ICE, again, relatively safe. You would think a lot of commodities trading going on. No, broke, continued lower, made more lows today. Pure Storage, this was a darling for a while growth stocks were working, from 35 down to 27.60 now. Don't want to hold on to that. Toll, one of the leading Builder stocks, harsh correction, big bounce yesterday on a positive reaction to earnings from one of its competitors, but it reversed hard off that 70 and closed below the 50-day moving average. Now, two that came off but can come back on if we were compiling a formal list, Lam Research. But this is what you're dealing with a lot of growth stocks now. Taiwan Semi made a very strong earnings report, and all these semi-equipment companies rallied in concert with it on Thursday, but this one reversed hard off the top. You think it failed, right? Well, no, it rebounded with a 6% up day today near the top of its all-time high. So the bottom line is that semiconductor equipment companies, for the most part, are acting fine, and this could go back on any leaders list. Frankly, anything that's near an all-time high has to be on a leaders list. That's the definition of a leader. Another one that came off but could go back on, NTR, but this is a very harsh correction, and it comes with this is just the type of environment that you're dealing with right now. Do you want to be in something in a stock that just all of a sudden down 6% and then followed up with another 6% down over the next couple of days, even though it then has a nice bounce and gets back above the 21? It's just not conducive to being long individual stocks. So that's our take on it. Now I'm going to go to, so I talked about the 8 that got cut. Let's go back to the 13. I know Hunter talked about some of these last week. You can just see how the decimation has continued for most of these. Some of these were absolute stocks that were absolutely holding up like rocks, and only about 3 or 4 of them you could consider that. Marvell up nice 5.5% today, but got hammered yesterday below the 21, and the 21 has rolled over. Micron, this is very clearly one of the leaders. Pullback bounced off the 21 near all-time highs. Looks fantastic. Tesla, terrible day yesterday. Anemic bounce today. It's below the rolled over 21 and the 50-day moving average. Devon Energy, oil stocks. I could have a 21 over 21 list of just oil stocks, but that doesn't imply that there's any broad leadership in the market, but Devon is very clearly a leader. Berkshire Hathaway, this is another one. Financials have been acting very well, and Berkshire is near all-time highs. Very nice breakout from this flat base. Apple, kind of working in concert with what's going on with the NASDAQ 100, but a little bit stronger, but it is below the 21. Palo Alto, leading cyber stock, not anymore. 21 rolled over, about ready to break the 50, broke the 100-day moving average and is below this key 500 area of support. And again, you're just gambling if you're trying to play some of these. ANET, leader for a while, bounced off the 21, nice bounce. We own this, it rolled over, we sold it, another bounce into the declining 21. This is a classic failure and an indication of a weak market when leaders bounce up to a declining 21 and can't get back through it. ANET did exactly that. Sienna, strong for a long time, couldn't hold the 21, and the 21 is now rolled over. O'Reilly, very defensive, that's even broke below the 21 today. NUE, big, nice move up here. You think NUE is fantastic? No, 4 days of selling, bounced up into the declining 21 and rolled over again. Builder, BLDR, ITB kind of rolled over the last week. This got back above the 21 in the bounce, but broke back below it today. And Vulcan Materials, another defensive sector, ugly day on big volume today, breaking the 21. So of those 13, maybe 2, 3 of them we're still in good shape. I will bring up some things that are near the top of our watch list if the market rights itself. This is day 5 of the correction, so we're always on the lookout for a follow-through day. But a follow-through day has to be accompanied by leadership. Qualcomm is certainly something that looks pretty good. Ford continues to look pretty good. The big 4 semiconductor equipment companies. I mentioned Taiwan Semi with their earnings. Broke below the low of the gap up day, but recovered it today. So we're going to keep an eye on how this continues to react as this kind of ignited the whole sector. KLA 10 Core, KLAC, gapped up, reversed, nice bounce up today. Money's got to flow somewhere, and until money starts coming out of the market, these lower PE, reasonable PEG ratio stocks, money will flow into them as opposed to something that's a high flyer with little to no earnings. LRCX, the last of, again, gapped up on TSM, reversed, but recovered most of that today. So it's helter-skelter type action. But those do look somewhat okay. Zim, Israeli shipping stock. This is a very clear leader, acting very well, belongs on any leaders list. Tech, TECK, looks fantastic. This is a metal mining stock, really the best looking chart of them. How about the networking companies, which were hot for a while? Juniper, barely hanging on to the 21-day moving average. These have corrected a little bit, and that's what happens. Things that outperform for a while, at some point, people just want to take their profits on it and move on or move to something that's safer. So Juniper, not as nice as it once was. We saw that with Sienna. How about F5 Networks? That was the leader for a while, but now the 21 has rolled over, although it bounced at the 50-day moving average today. So not a whole lot of places to hide. ON, still holding up okay, bounced at the 50-day moving average. But again, a leader, breakout near all-time highs, 4 harsh down days, bounced at the 50-day, got back above the 21, failed at the 21. This is typical of what you're seeing in anything that's attempting to be a leader, and you're just better off. Discretion is a better part of valor right now. As far as growth stocks go. So I just kind of skipped over the tail of the tape, so let's go through it very quickly. Let's go back here to the S&P 500. And the key that we want to watch next week is these moving averages on the S&P 500. And again, we don't want to make lower lows, which means we don't want to break below Monday's lows in the S&P 500, which was 45.66. The 100-day moving average is at 45.75. So, excuse me. So that's a key area that we want to watch. Our bull case, we've broken below the 21 and the 50 on the S&P 500. We've been playing ping pong back and forth, but ping pong is a fun game, but not when you're playing it with the market. So you can't trust anything that's going on right now. Coming into today, I want to watch to see what happened with the S&P 500 versus the 50-day. We did close at the high of the day, but we still are below the 50-day moving average. The NASDAQ composite, I normally pay more attention to the NASDAQ 100, but you do need to have a reference. And we did bounce a second time at the 200-day moving average on the NASDAQ composite. So this is also a very key area to watch for next week. You don't want the NASDAQ composite to break back below the 200-day moving average. That's going to wrap it. As always, like to hear from you. You can shoot me an email, don@revereasset.com, or phone 855-REAL-WEALTH. Wrapping up, excuse me, wrapping up the week ending January 14th. This is Don Vandenbord telling it like it is. Thanks for listening and have a great day.